Welcome to the Simple Mind Space podcast. This is a space where we discuss essential skills for managing personal finances and share insightful life experiences to help you navigate your financial journey with greater confidence. If you're new here, we encourage you to explore our website, where you can find a treasure trove of valuable resources, all offered absolutely free. All right, let's dive into today's topic: how to prepare when the economy declines and inflation soars. Over the past several months, if you've been paying attention to the financial news, you've witnessed a stock market on a roller coaster ride with a consistent downward trend. Just look at the US market. Major global companies like Google, Apple, and Microsoft have all experienced a significant decline, dropping at least 20% to 30% since the start of the year. And remember, these are well-established companies with solid business models and robust financial backing. Now picture this. You've worked hard for years, carefully saving up $1 million. You decide to invest it in the stock market, hoping to see your wealth grow. But within 6 months, the market takes a nosedive, and you've lost half of your investment. You're now left with only $500,000. That's a gut-wrenching feeling. And to add insult to injury, no one can tell you for sure if the downturn will continue, for how long, or if it's just the beginning. This uncertainty is mirrored in our everyday lives as we face the relentless rise in prices. This, my friends, is the story of inflation, a term we hear frequently these days. So what exactly is inflation? In simple terms, it's the erosion of our money's purchasing power. Let me paint a picture. Imagine your car has a 5-gallon gas tank. In the past, $100 would fill it up, but today, that same amount only gets you 4 gallons. Essentially, your 5-gallon tank now effectively holds only 75%, meaning inflation has crept up by 25%. And if you want to top off your tank, you'll need to shell out $125, an extra $25 thanks to inflation. This example highlights how inflation can appear straightforward. However, in reality, it's a stealthy foe that gradually chips away at our wallets, often going unnoticed until it's too late. This slow creep often leaves us unprepared, without adequate financial defenses. The truth is, whether we like it or not, we're caught in a storm of economic challenges, not only at home, but globally. Looming over us is the lingering impact of the pandemic. While most of us have been vaccinated, the threat of new variants and the economic scars left behind remain. Coupled with this is a global economic recovery that, while showing signs of progress, still faces headwinds in certain industries. This uncertainty translates into rising costs, impacting our daily lives and financial stability. I'm sharing these insights not to alarm you, but to emphasize the reality of the situation and encourage you to take proactive steps to secure your financial well-being, regardless of the economic turbulence swirling around us. In this first installment of our multi-part series, I'll focus on the most crucial aspect of weathering this financial storm: building a robust, personal finance management system. This system will act as your financial fortress, protecting you from the unexpected. Think of it as your financial lifeboat, keeping you afloat amidst turbulent economic seas. The core of my recommended system is built on timeless financial principles. Save before you spend, have a method for managing and tracking expenses, and have a financial cushion for emergencies. Let's break down the system. First, consider your income, whether it's your salary or any other source of income you have. Once you receive it, immediately set aside a fixed portion to cover your essential expenses. The amount you allocate will depend on your individual financial situation. It could be the bare minimum to survive, or it could be a more comfortable standard of living. Once you've allocated money for basic living expenses, divide the remaining funds into 3 separate accounts. Emergency fund. This is your safety net for unexpected events like job loss, medical emergencies, or major home repairs. Once this account is fully funded, move on to the next account. Sinking fund. This account is for planned future expenses, such as home renovations, car replacements, or a new laptop. Contribute consistently to this fund until you reach your savings goals for each item. Investment account. After funding the first 2 accounts, direct any remaining funds towards investments designed to grow your wealth and potentially outpace inflation. We'll delve deeper into investment strategies in upcoming episodes. This model, with its clear structure and account allocation, is the very system I've implemented for myself, and it has proven invaluable in maintaining control and peace of mind, especially during the market swings and price hikes we've seen recently. Having these reserve funds not only strengthens your financial standing, but also instills a sense of peace of mind. Knowing you have a cushion for emergencies and planned expenses frees you from constant worry and allows you to sleep soundly, even as the market takes a tumble and prices fluctuate. The next crucial step is to eliminate or minimize debt, especially in times of economic uncertainty. It's no secret that not all debt is bad. There are types of good debt, such as loans taken for investments that have the potential to generate returns exceeding the interest paid. However, in the current climate, it's prudent to exercise caution and prioritize debt reduction. Why? Because with inflation on the rise, central banks often raise interest rates to try to curb its effects. This means the cost of borrowing money increases, making existing debt more burdensome. If you have outstanding loans, especially high-interest ones, prioritize paying them off as quickly as possible. For those who are fortunate enough to be debt-free, strive to maintain that position and avoid taking on new loans unless absolutely necessary. Think of it this way: carrying a heavy load of debt while navigating a turbulent economy is like trying to sail a ship with holes in its hull. Every wave, every gust of wind threatens to capsize you. By shedding unnecessary debt, you're patching up those holes, making your financial vessel more seaworthy and able to withstand the storms. As I mentioned earlier, these recommendations are preventative measures. Just like reinforcing your home before a hurricane, these steps aim to prepare you for any financial challenges that may lie ahead. While the current economic landscape may appear daunting, it's essential to remember that economic cycles are a natural part of the journey. With a well-structured financial plan and a proactive approach to managing your finances, you can navigate these turbulent waters with confidence. In the next episode, I'll delve deeper into smart investment strategies to make your money work for you, even during a downturn. We'll explore different asset classes, risk management techniques, and how to identify opportunities amidst market volatility. Remember, with knowledge and preparation, we can turn challenges into opportunities. Thank you for joining me on this journey towards financial resilience. If you found this episode helpful, please like, share, and subscribe to our channel so we can reach more people seeking financial guidance. Until next time, stay informed, stay prepared, and stay empowered on your financial journey.